The earning per share, so this is related to finance. We'll talk about this in finance. Or when company use a share repurchase program. We'll talk about later. For example, company issued too much shares and now company realized that our earnings is going to be distributed among huge number of shareholders. What if we decrease the number of shareholders? Then our earning is going to be distributed among small number of shares, right? So earning per share increases. So they repurchase the share. So what is the entry? So first of all, the recording must be recorded at cost, which means not on the par value. So if you buy back stocks $3,300, so you just recorded $3,300. And remember, so treasury account is a contra account of the common stock. If common stock increases, it's credit. If treasury stock increases, it's debit. Decrease in common stock equity, right? So the following entry record repurchase of 74 million shares for 4 billion. So remember, there is no paid in capital, there is no discount, there is no premium here. So there is no par value here, right? No par value. So $4 billion worth of share they buy back. So buy back against cash. So cash decreases, credit. Treasury stock increases, debit. So treasury stock to common stock, treasury stock to cash, $4 billion. That's it, right? Now, how the common stock is, how the treasury stocks are shown in the balance sheet. So we have a common stock, paid in capital, retained earning, other comprehensive income, and you see treasury stock. And it could be written in negative form. So treasury stock decreases the common stock equity. So increase in treasury stock is decrease in common stock equity. So that's why it is debited. So let's move forward. What if we want to retire this treasury stock? For example, we buy back our shares and we cancel the shares. We have no intention to float this in the market or to throw in the market or sell in the market. So first of all, we need to cancel the stock certificate, which means this stock cannot be issued ever. So once shares are repurchased, neither total assets nor total liabilities are affected. Why is that? Because when you repurchase your own shares, so what happened? Your common stock is now not affected. So memorandum entry made decrease number of shares issued in stockholder equity. So if you retire the stock, you delete the stock, so your paid in capital increases, only number of common stock decreases. That's it. So we have illustration here which shows basically this is your outer class activity or your breakout room activity, but we will solve it together. We don't have much participants here, so we'll solve it together. So pause the video, those who are watching online, and try to solve it by yourself, and after that compare the answer. So let's see the illustration here. So December 31st, 2014, the Hartnett Corporation reported shareholder equity as follows. So we have common stock 1.50 par value, and they have issued 2,400 million shares. So common stock 3,600 million, paid in capital in excess of par of the common 7,200 million. We have a retained earning and we have a treasury stock 85 million. Total stockholder equity is 12,205 million. So number one, in 2025, the next year, The issuance of 16 million shares of common stock, 10 per share. So the par value is 1.5 and they are issuing 10. So 10 minus 1.5, answer is 8.5 is the paid in capital in excess of par, and 16 multiplied by 1.5 would be the common stock. So what is the entry? Cash received $160 million, because 16 multiplied by 10, $160 million. Among this 160 million, common stock is 24 million and 136 million is paid in capital in excess of par, common, because we are dealing it with common stock, right? That is the entry. Now the second one is purchase 6 million share treasury stock worth of 100 million. So there is no par value here. So we purchase stock, cash decreases, treasury stock increases. So answer would be treasury stock to cash, right? And the last one is sold 3 million treasury stock in part B for $70 million. That is very important. So we purchased here 100 million, 6 million we purchased back with 100 million, right? And now half of them we issued, it means we earned some profit. So we call this paid in capital in excess of treasury stock, right? Treasury stock. So if you see, so 6 million shares issued at 100 million. So 3 million shares worth of 50 million. So we issued with 70 million. 20 million is basically our premium, our paid in capital in excess of treasury stock. That's it, right? So remember, we do not call in accounting for shares as premium. We call this paid in capital in excess of what? Whether it is common stock, whether it is preferred stock, whether it is treasury stock. So there is a separate head of all these, right? Now, what if we issue shares for employee compensation? Remember, employee compensation, like our legal fees, is our expense. So employee to common stock to paid in capital if there is any paid in capital in excess of par. So here, Home Depot issued 21 million new shares. So this question is like just for for you to understand the entry, because the figures we don't have it. So just remember that one. It is the same as we issued shares in our previous entry for legal fees. The same entry is there. So how treasury stocks are mentioned? Treasury stocks are mentioned in negative here. So you see negative here, right? Now our last learning objective is how we account for retained earnings. So what is the formula for retained earnings? So closing retained earning is equal to opening retained earning plus net income minus dividend. Remember, we call our formula this. Opening retained earning plus net income minus dividend. So let's see that. Net income, any losses, less dividend declared. So it means retained earnings are the earnings that we did not share from the past years. We retain, we accumulate over the years of the corporation lifetime. So it has a credit balance, yes. If retained earning increases, it's credit balance. If retained earning, it has a debit balance. If debit balance decreases, it means retained earnings are going negative. So it's a debit balance. But it will be shown under stockholder equity. So should the company declare dividend and pay cash dividend? Answer is yes. So there is how basically dividends are paid. Dividends are paid in either in the form of cash, either in the form of stock, or either in the form of non-cash assets. So normally dividends are paid based on earning. If the company is earning profit, so they share some profit to the shareholder. But that doesn't mean that dividend can be in form of cash. Dividend can be in form of shares as well. Company issues new shares and instead of giving you dividend, they give you new shares. Instead of giving you, the cash, company can give you some products. For example, company makes some laptops or mouse or keyboard, company can give you keyboards or laptops, right? Non-cash assets as well. So cash dividend, how we are going to account for cash dividend? Remember, company must have both enough retained earning to declare the dividend. Remember, when the declared date of dividend and payment date of dividend are two different things. When dividend are declared, it means company is now obligated to pay, but payment date can be different. The second stuff is company must have enough cash to pay. Remember, the profit and the cash are two separate things. Sometimes we don't have cash, but we have a profit. Cash will come after some time, right? So in order to pay the dividend, company must have cash in the company's account. So board of directors has authority to declare the dividend. So company are not obligated to pay the dividend until it is declared. Once company board of directors decide to pay the dividend, then it is obligated for the company to pay the dividend. So dividends are paid on the date. There are 3 dates that must be relevant. Number 1, declaration date, when dividend is declared. So dividend is declared today, but paid on the 1st of July. Declared right now, right? So there's going to be entry. And then company record the dividend. There is no entry for recording. And then company pay the dividend. On 1st July, company pay, then payment entry will be there. So we have illustration so that you understand. On June 19, the board of directors declared 50,000 cash dividend. Declared. It means they didn't pay the dividend. So it means they are obligated to pay. Pay later. You create liability. So when you declare the dividend, entry gonna be retained earning decreases because dividend decreases the retained earning. Formula is retained earning, opening retained earning minus plus in net income minus dividend